just give me a call, 855-500-TRUST, and that will get you into our main lines, and we can get you, if you got a tax situation you want to talk about, we can get you in with Rich, and he will be in the air with us shortly. And if you want to get in with me, then I'm happy to talk to you about your estate plan. Today, what we're going to be doing is I want to talk about a couple of things that came up I'm trying to think, and man, it happened so fast. Basically, the last couple of days, I had somebody that was asking me specifically about how, why you should care about the Secure Act and Secure Act 2.0 and Secure Act 1.0 and what that means. How does that affect estate planning? The question specifically was, does the Secure Act, how does it affect my trust, if any? And there was the question really made it pretty obvious that we need to discuss that on this show. So I figured we'd do that. One of the things about the Secure Act, the main thing with the Secure Act is those that are affected by it are people that have a retirement account, and they are going to contribute money to a retirement account still, and also people that are inheriting a retirement account. Those are kind of the two big things. So the Secure Act has to do with retirement accounts. So first of all, if you have a retirement account and you are under 60, like 65, right? So you haven't started drawing on it necessarily. You are beyond where, the penalties. So you could draw money out of an IRA or a 401k, assuming it was authorized by the plan, but you could do it without being penalized, for early withdrawal penalty. Of course, it's taxed. We're talking about, 401ks and, traditional IRAs. So you'd be taxed on it, but you wouldn't be penalized for pulling it out early. Okay, then there's this thing called the required minimum distributions. It's an amount that you must take out. And if you do not take out the RMD, required minimum distribution, then the IRS can penalize you. And the penalty is 50% of what you should have taken out. So what will happen, let's say, for example, you were supposed to take out $10,000 for whatever reason, because that was the RMD. If you didn't take out the $10,000, the IRS would penalize you $5,000. And it is extremely difficult to get out from under that penalty, because anytime you have an IRA, the IRA custodian, unless you're like, super brave and everything's self-directed and you don't have anybody managing it for you. If your money's under management, or if it's in, it's with any institution, they're going to be saying, hey, required minimum distributions, make sure you take out your RMD. And like, you'll be getting notices like even about now, they'd be going and figuring out exactly, what your RMD would be and telling you got to figure it out, So RMDs, there's really no excuse for not taking out their proper RMDs, and the IRS feels there's no excuse, and that's why they charge you that humongous penalty. Okay, that's the basic. And with the Secure Act, basically you can wait until 71 to start taking out your RMDs. It used to be you had to start taking them out at 70, and then 70 and a half and 71. So they're moving those dates a little bit. Now, as far as inherited IRAs, that is the huge change with the Secure Act. What it did is it got rid of what we used to call the stretch IRA. The old rule was, if I inherited an IRA from my dad, and it would become my IRA, and then the RMD would be taken out based on my life. Okay, so if I looked at the chart and the chart said, okay, your RMD is 1/30th, because I had 30 more years to live, then I would have to take out 1/30th. Then there were other rules where I might have to take out an RMD based on my dad's life, depending, but typically it was based on my own. Okay, now what I would do then, I would inherit an IRA, and I would stretch it out for my life rather than just my dad's life. Or I wouldn't have to go into my dad's RMD period. I could go into my own, which would stretch it out. It's called a stretch IRA. Now, what would happen under the Secure Act is they said, no, we're not going to do that. You can't stretch it out for your life. You have to, with any inherited IRA, you have to pull it out of the IRA within 10 years of the date of death. And if you didn't get it out within 10 years, there's a 50% penalty on whatever's left after the 10 years. So if you didn't know what you're doing, you didn't pull out any money at all, and then on the 10th year you missed it, you forgot to, and then you didn't pull out, and it's a $200,000 IRA, you're going to have $100,000 penalty. I mean, there's massive penalties. So with the Secure Act, you just wanted to be really careful, making sure you took out the RMDs on inherited IRAs. The way the Secure Act affected estate planning is because of the technicalities of it eliminating the stretch IRA. It made it so that a lot of people then thought that their trust would not work as a stretch IRA trust, because we used to have a thing we'd call a stretch IRA trust. I use a thing called a retirement protection trust or an inherited IRA trust. And I want to tell you why you should have one of those when you have an IRA. Okay. Because think about this. With your IRA, you try to figure out who gets it after you die. I look in the IRA and I look at the beneficiary designation, and it says, okay, Gary, when you die, it's going to go 25% to Matt, 25% to Brianne, 25% to Tyler, 25% to Ryan. No, that's my alternate beneficiary. My primary beneficiary is my spouse. So it's going to go all to my wife, but if she's not alive, then it's going to go 25% to each of my kids. And that makes sense if all my kids are financially mature and they know what to do with the money, and they're not going to just waste it, and they can figure out how that money comes out under the Secure Act. Okay, if they weren't in the position where they understood all that stuff, there's got to be a different way for me to do it. What I want to talk about coming up next is exactly what I mean. Okay, how do I use a living trust with my IRA, my inherited IRA? How do I use that to make sure that the money gets handled properly by beneficiaries? That's coming up next on The Word on Wealth, 855-500-TRUST.
You've got questions. We've got answers. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQlaw.com. You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is Faith-Based Investing with Anthony Wright.
Most Christians just don't understand that the money they save for retirement usually helps fund the abortion industry and other liberal anti-family causes. But did you know that with just a few minutes of your time, we can screen and clean your investments at no cost to you? It's absolutely complimentary. Just go to the website right now, download a free copy of my book, Faith-Based Investing. It's free as well. You deserve to know the truth as the investor. Then the choice is yours. You can keep doing what you're doing, or you can line up your investments and life savings with your beliefs. We are fiduciary investment advisors. You can feel good about investing with confidence. So learn more now. Go to BibleSafeInvesting.com or call me at 931-RETIRED. Your free book is waiting for you. Go to BibleSafeInvesting.com and be sure that you listen to Faith-Based Investing this weekend right here on Family Call.
Gary, how do you and your team help our listeners avoid probate?
Well, first of all, probate is a process that involves attorneys, judges, and sometimes contesting parties. And so we try to avoid probate at pretty much all costs. The way we do that is setting up living trusts, setting up properly documented wills, putting the property like houses, cars, bank accounts in that trust so that it avoids probate. Probate is only necessary if the estate plan isn't set up quite right. So we help them get it set up right. And mainly that's done through a properly created living trust.
Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free initial consultation. That's GQlaw.com, 855-500-TRUST.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush of The Word on Wealth. You hear Ken every week here on The Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group, from single-family attached homes to luxury high-value waterfront properties to apartment buildings. Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com, or call 619-977-8419.
DRE number 010566969, brokered by eXp Realty.
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST, gqlaw.com.
You're live. And here we are. Okay, what I was going to tell you about was, if you want to be part, obviously, if you want to be part of the show, call us 888-344-1170. And I'd be happy to take your call and answer your question. We're talking about dealing with trusts and making sure that you've got it right, specifically having to do with retirement accounts and specifically IRAs. Okay, so a lot of people have IRAs, a lot of people have 401ks, and those are treated basically the same when you inherit them. It may be that your dad had a 401k because he worked for a company, whatever, right? If you inherit his IRA, his 401k. So if you inherit your dad's 401k, because that's his company plan that he had, when you inherit it, it's going to be considered an inherited IRA. Even though it was a 401k, now it's an inherited IRA. The inherited IRA is not an IRA. It's an inherited IRA because they're completely different. Okay. The inherited IRA now would also be something where if your dad had just an IRA that he had put away, it could be, self-employment IRA or regular IRA, traditional IRA. When that money is inherited by you, it is an inherited IRA. When you get that money now under the Secure Act, you have 10 years to pull that money out. That doesn't mean you have to spend it in 10 years. That just means you have to pull it out. So if you have $100,000 in an IRA, you could pull out $10,000 a year if you want, but you could pull out less. And then before the end of the 10th year, you would have to make sure that you pull out all of it. Okay. And the required minimum distribution, the RMD that comes out, that's a very specific calculation. I'm not going to go over it here on this show. We can talk about it, but it's based on a chart, and the law has changed quite a bit in this area. The law changed in 2019, and then in 2020, 2021, 2022, there have been different interpretations from the IRS on what it means and what the required minimum distributions are. Okay, so let's just say you have an inherited IRA, and it goes to you, and that's fine because you're financially mature and you can handle it and you get the money and all that good. Okay. Now let's go into a situation where instead of you getting the money, it's your IRA. You're the one that dies, and now the money goes to your kids. Well, if you're, 50 years old or 60 years old and you've got kids that are younger, let's say that your IRA or your 401k is now going to go to your children, and the kids are, 20 years old or 18 years old or 16 years old. Now we know a 16-year-old shouldn't have any money inherited. Totally fine. I know maybe they're super financially responsible, but they're 16. They're not an adult. They're not supposed to have inheritances directly, especially IRAs and things like that. But let's talk about your Your children that are maybe, 18, 19, 20, 22, 23, do you want them to have your $500,000 IRA? I would say probably not. If you set up a trust, which is what my job is, I usually recommend in the trust that you have part of that $500,000 IRA and part of all of your assets held in the trust until the kids are financially mature. So let's say you put together a trust and you decided that the best plan would be that your kids, instead of getting 100% of their share on your death, you said, hey, that share is going to stay in my trust designated for that child. And that child can have 25% of their share, 25% of the principal of that share. They can have 25% when they're 25. When they're 30, they can have half of what's left. And when they're 35, they can have the balance. And if they need money in between those scheduled distributions, they can get early withdrawals for education or maybe for essentials. Like if they can prove to the trustee that they can't survive without that money, then the trustee can pay some of their bills potentially. Okay, so if that's the way you're setting up the trust, so that means the house gets sold, the investment accounts, all that stuff is handled by the trustee, paid out to the kids at these staged distribution, 25, 30, 35. Okay, so that's good. Got that. However, about $400,000 of your assets is in an IRA, which now becomes an inherited IRA. And if you made your IRA go directly to your 4 children, they're going to each get the $100,000. Maybe that's okay. Maybe that's enough. But what if you have $800,000 in an IRA and it's going to go $400,000 to each of your 4 children or $200,000 to each of your 4 children? Is that too much? What I usually want to do is have it so that that retirement account, the IRA, doesn't go directly to your kids unless they're already financially mature. Instead, it goes to the trustee of the trust for the benefit of the child. So it'll say 1/4 to Susie, and basically to the trustee of the trust for the benefit of Susie. And what that does is it gives the trustee of your trust, this financially mature individual that you selected to be your successor trustee, they're the ones that are contacting the retirement company, the company, the broker, whatever, the organization that's holding on to the money, the custodian. They're the ones that are saying, okay, it's time for an RMD out of that account. And here's how we're calculating it. Give it to me for the benefit of Susie. Then that trustee, instead of handing it to Susie, the trustee deposits that in Susie's share of the trust account. Okay. And the trustee can do that each year that there's supposed to be a distribution. So the money that's being gathered in the trust, that is the money that says you can give her the interest or give her earnings or make an allowance to her. But at 25, she can have 25%. At 30, she can have half, 35, the balance. So the IRA just keeps getting moved into that trust account. It's drawn from the IRA, taxes paid, put into the trust account. And that way that money is scheduled out. What a lot of people do is they'll just say, oh, forget it. I'll do my trust. My trust will manage my house, but I'm not going to put my investment in there. I'm not going to put my IRA. I'm just going to give it directly to my kids. And that's okay. But I have seen many times where that is done. The parents are in their 50s. The kids are in their, teens and 20s. And they've got a lot of money put away, $500,000, and there's 2 kids. So now mom and dad pass away. And each of the kids have $250,000 and they're 18 and 19 years old. I don't think that's a good plan. Most 18 and 19-year-olds don't know what to do. I mean, we all know what to do with money, spend it, right? But the real thing they should be doing is putting it away in a retirement account or investing it properly and getting the proper people rather than just spending. So what I usually want to do is, instead of it going directly to those beneficiaries, I want it coming through the trust. Okay. Now, to make that happen, and this is the important part, your trust has to be a retirement protection trust. It can't just be a plain vanilla trust, which are fine unless you're trying to manage an IRA through the trust, which I mean that your successor trustee is the one working with your custodian of your IRA. They're the ones that are calling the shots and saying, give me the RMD to put in the trust on behalf of Susie for her benefit. So you need to have the trust set up right. I refer to them as an IRA protection trust, retirement protection trust. They're called IRA conduit trusts. There's different ways to set them up. They're called different things. But the trust has to have that kind of language. Old trusts, especially trusts where before the Secure Act came out, it just wasn't a thing. So most of them don't address the fact that we want the IRAs and the retirement accounts to be handled by the trustee. The way it works is you can amend your trust. So you don't necessarily have to have a brand new trust. I mean, if your trust is 15 years old, it's done its job, get a new one, unless it's, unless it really will serve your purposes. And if it's 15 years old, 20 years old, maybe it's time to rewrite it, do a restatement, keep the same creation date so your house is still in the trust and all that stuff. And we're careful with that. But you might want to get the trust rewritten, because that way you have a new trust, a new binder, everything is all new and fresh, and it's compliant with the new rules, it's compliant with the IRA rules, it's, a retirement protection trust. The other way, though, instead of rewriting the whole thing, is you can do an amendment. So there's a possibility, sometimes I'll review a trust and I'll recommend that you should make this a retirement protection trust. And to do so, I would need to change this section and that section and this section, and here's what's going to cost you. So it's possible to amend the trust to where it will comply with the rules for a retirement protection trust. Sometimes we have to do it, sometimes we don't. Sometimes we amend, sometimes we do the whole thing over again, which isn't a bad thing. And if your trust has been around for 15 years, it did its job, it's worth the money, right? And so maybe it's time to reset, maybe not. Most of the time, I'm amending trust rather than doing a restatement. But so that's stuff to consider. All right. Now, if you don't do an IRA trust, then keep your retirement plan out of your trust. Because if you don't have an IRA or a retirement protection trust, and the IRA says on it that my beneficiary it goes 1/4 to my son or successor trustee for my kid. If it's not a retirement protection trust, that means that money has to be drawn out in 5 years rather than 10. So it doubles the amount it shortens the amount of tax at the time that it has to be taxed. You're going to have to be pulling out twice as much as you would if it was a retirement protection trust set up properly. So a regular plain vanilla trust, if the beneficiary is going to be the successor trustee on behalf of one of the trust beneficiaries, the IRA beneficiaries, then it's going to accelerate the taxation to 5 years. So now you're going to have to grab it in 5 years. Now, it is not uncommon for a trust, when we're trying to settle it, depending on how many investments and all the stuff that's kind of looping back in and having to be dealt with, it's not uncommon to have a trust take 6 months to 12 months to finish the distribution, because things are settling, investment accounts are being moved around, real property is being sold. So you just don't want a 5-year trigger. You want a 10-year trigger. And the 10-year trigger, you'd have to have a retirement protection trust to get
2 minutes.
Okay. So we can talk about that. I can review your trust. For my clients, what I'm willing to do for listeners is do a free trust review. If your trust is like, if you did it in the last 2 or 3 years, it's probably, unless you're going to change a beneficiary, or unless you just really think, man, this thing is really sloppy. But if it's done within the last 2 or 3 years, it probably does not need to get reviewed, unless you know that you need to change your trustees or change your distribution. But older trusts, if you're looking at a trust that's 5, 10, 15 years old, it's probably not compliant with the current laws. If you have somebody that knows what they're doing that can review it for you, fantastic. That's great. Not everybody does. So if you don't have someone that can help you out to set up your estate plan, to review what you've got, to do an amendment, to make it conform with the IRA rules, Secure Act and all that, call me, 855-500-TRUST, and me and my team can be your people to take care of it for you. All right, coming up next, we've got Rich Mathurin of GQ Law. And GQ Law is the one that sponsors the Word on Wealth every day of the week, which is so terrific. We appreciate that. But Rich from GQ Law is going to be coming in. We're going to be talking about tax problem solving and tax issues, because some people you just fall behind in taxes. It's been a year, it's been 2 years, and maybe you're stuck. Maybe you got a family member, a friend that's stuck. Maybe you're a small business person and you got stuck because you just filed a return and go, oh my gosh, I should have taken a bigger credit. I should have done this, whatever. That's the kind of stuff we sort through. Audits, audit reconsideration, tax preparation. We can handle all that at GQ Law. And we got Rich Mathurin to come talk about that. Coming up next here on the Word on Wealth. All right, so we're going to go right to the top of the hour. Keep our number in mind. You're going to call us at 855-500-TRUST. And when we come back, The next thing we're going to do is get you to call and ask Rich a question about your tax situation or your friends, and we'll help you resolve it right here on the Word on Wealth.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We are here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com, 855-500-TRUST. Not alone. Ask for the legal help you need. Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or text to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com, 855-500-TRUST.
Go ahead. Welcome to the Word on Wealth. This is Gary Quackenbush, and hey, Rich.
Hi, Gary.
Rich is on with us every Monday. He is the head of the tax department, sometimes the tax department, but we've got tax preparers helping us out. Rich has got his crew helping him out with tax problem solving, and that's one of the things that we've been doing at GQ Law for a super long time. And what we do on our Monday features, we have Rich come in and talk to us and answer our questions. And we've had some really good response from you listeners. If you want to give us a call, we'd be happy to talk to you on the air, and Rich can answer your questions off the cuff here at 888-344-1170. Call up and then, listen up, see if it's something that can help you with. Rich, one of the things a lot of people, it's embarrassing. You have a tax situation, you fall behind your taxes, and it's like, oh, everybody knows you're supposed to file your taxes and pay them. But I guess we find a lot of people that don't. It just happens.
Keeps us in business.
Keeps us in business. So we've been talking every week. You come in and we talk about a lot of times the IRS, that they're pretty aggressive. There are some other tax agencies with taxes that we are concerned about. So give us a bit of a rundown, like in an overall general, like organizations get taxed by certain entities. And we know Internal Revenue Service, that's federal, and they deal with personal income tax, corporate tax, payroll tax, and all that. What are some other the tax agencies that like a small business would get, or even an individual would have their encounters with?
Well, the first one that's most obvious is people when they have IRS problems usually have state problems too, and that would deal with the California Franchise Tax Board. FTB is what the acronym they go by. They are very, very aggressive, probably much more aggressive than the IRS. They have they'll garnish your wages, they'll levy your bank accounts, they will actually send garnishment orders to your customers if you're a small business. I've seen that. They do a lot of imputed income where I think we've talked about this in the past, where they take if a mortgage interest statement, if you didn't file a tax return and they get a mortgage interest statement from a mortgagor, they will impute income to you, I think ×6 sometimes the mortgage interest paid. Also, they do the normal business. If you're like a hair salon and you haven't filed a tax return, they might take an average hair salon in California and use that as a basis for assessing taxes against you. So they are very, very aggressive for a small.
And so that's where, let me just kind of get clarifying that a little bit. So like the Franchise Tax Board, that's the state of California Franchise Tax Board. And it's funny that it's called Franchise Tax Board because it doesn't sound like an individual thing, but it is personal income taxes you pay to the Franchise Tax Board, and then the business thing. So when a really common thing that it sounds like you run into is that people don't file. They're supposed to file by April 15th, and there's extension deadlines and all that. But how long? I mean, the state of California, we know, has the ability to come in, and it sounds like they really have some clever ways of kind of calculating your tax or estimating your tax. So how long, like if I haven't filed a tax return to the Franchise Tax Board, let's say I was supposed to file April 15th of this year and I didn't, how long is it taking the Franchise Tax Board to kind of figure that out and catch up to people?
They're pretty quick. I would say, 2 or 3 months that's what I'm seeing. They're very, very quick to react. They get the returns, they're smaller, so they get and process the returns much quicker than the IRS does. They get all the information. I guess the one good thing about that is you can deal with people you can get a name of a representative and call and deal with that person going forward. Whereas the IRS, you just call and you get a random person every time you call. So that is the good thing. But at the same time, they're, like I said, they're very aggressive. My own personal thing, I think I had the health insurance proof that you didn't file. You have to file along with your tax to prove that you paid for, you had health insurance. I think they were on me within maybe 30 days of not filing that. So, I mean, that's just a personal anecdote.
There's just a lot, and if you compared that to the IRS, so if you don't file a tax return with the state, they'll know within a couple months, they're going to be bugging like, where's your return? Compare that to the IRS if you didn't file an IRS return.
That nowadays it could be a year, 2 years type of thing.
Interesting.
It's a big difference.
Right. And that just proves, I mean, the Franchise Tax Board, state of California, they're just much faster on top of it. Now you're talking about imputing income. So that would be somebody hasn't filed their taxes and they didn't file a tax return, but then the IRS gets a statement from the mortgagor, so your lender, telling the Franchise Tax Board and the IRS and you how much money you paid in mortgage interest. So the state of California, you're saying, will take that number, and if it's, let's say it's $15,000 of mortgage interest, which is not uncommon. Well, let's use 10 because it's easier math. $10,000 of mortgage interest, they're going to multiply that by 6, and they're going to say, well, whether you filed a tax return or not, we believe you earned at least $60,000 that year, and then they will use that number to do what?
Assess taxes against you. They do what's called a notice of proposed assessment. It's similar to the substitute for return with the IRS that we've talked about, where they get income information, whether, like a mortgage interest statement, 1099, a W-2, and they impute that income to you, and then they do a tax return and they give you the standard deduction, and then they tax you at the highest rate. They call it the notice of proposed assessment.
That's interesting.
And then they assess those taxes, and penalties and interest start accruing. Once they assess that,
Okay.
those are also, like we talked about with the SFR, the substitute for returns. Those are not dischargeable in a bankruptcy, even if you fix it
Okay.
later on.
So they're going, they're taking your W-2. That would make sense. That's reported by your employer. And they're taking 1099s. That makes sense because that's reported by, you have to report those. I mean, if you pay somebody more than $600, you're supposed to do 1099. So that all makes sense. Then you had mentioned one other thing, which I'm always fascinated by. It's really fascinated me a lot. Like the IRS, I'm sorry, the state of California Franchise Tax Board, they'll also take that, oh my gosh, I'm forgetting the sentence. It's the occupational, they get the number based on where, like you were saying, a beauty salon. So where does that number come from? How do they know that the person is running a beauty salon or something like that?
I don't know exactly how they get that information. Maybe through the Secretary of State business filings. They probably,
That would
I
make
assume
sense.
they would probably match those numbers. And if they don't see that you filed a return, they'd ask what's up and probably try to put two and two together. So
Oh, that's interesting.
that's
And so from that, they'll just say, okay, we noticed you got a, San Diego hair salon license, and we also noticed that there's no tax return filed. So we think that a hair salon would have made X amount of money. So we're putting that on this tax return. So here's your tax liability.
Yeah, it's rare, but
Yeah.
we have had occurrences of that. One other thing that they can do that's important to keep in mind is they can suspend your business license with the California Secretary of State. If you are, if a business is in default and hasn't filed tax return or hasn't paid there, they can suspend your business license with the California Secretary of State.
Well, so and what is the effect of them suspending a business license? That makes it illegal to conduct business.
Yeah, you're not supposed to be operating. And I mean,
Wow.
a lot of our clients, we get them back into compliance, but you have to, you're not supposed to be operating your business. You have to basically revive the business, pay the back taxes, pay the back corporate fees. I think it's an $800 a year fee for a corporation or an LLC in California. And then file this certificate of reviver to try to get them to revive your business and reinstate your license with the Secretary of State.
So it sounds like really and this is like, I know this kind of goes without saying, but the thing about filing your taxes, it sounds like what we're saying is that we know there's a requirement to file tax returns and the deadlines, and we've got all that stuff. And then it's almost like it doesn't matter whether you know that there's a requirement, there is a requirement. And the state of California is not going to call and say, hey, did you guys know that people file taxes here in the state of California? They basically move forward with the numbers that they have. They see that you have a license, or they see that you formed a corporation and that got a license. So there's all these things. It surprises me. I don't know whether it surprises you or not, but it kind of surprises me that they'll get a business license, they'll form a corporation, and they'll do these things to kind of like get started in business and then don't file the returns. And it just seems, I mean, is that something you see quite often?
Yes. Very often we have, maybe they've filed personal returns, but they haven't filed business returns. I've had clients that, haven't filed since like 2000. So, it's like 20 years type of thing, not filing.
And there is hope for that type of thing. Is there a way? And I think Rich is going to be on with us till the top of the hour. And what we're going to talk about after we come back is like, so what is the solution? Okay, you haven't filed in years. The state is coming after you. They're making up numbers. They're using all their calculations, whatever. It almost seems hopeless, but I know, Rich, there's hope, right?
Oh, definitely.
Okay. So we're going to be talking about that up next. Okay. If you have your favorite tax person, great. Most of the time, what happens with Rich is that we'll have a tax professional that's getting your returns done. Maybe it's your own tax professional, but then it's like, wait, these are late, these are delinquent, there's penalties. And that's when we get involved at GQ Law. Call us up 855-500-TRUST, 855-500-TRUST, and we will help you fix your tax problem. We'll be right back on The Word on Wealth.
Questions? We've got answers. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQlaw.com.
So, Gary, we've talked a long time about estate administration. So, what is that, and why is it important?
Estate administration is the distribution part of estate planning. So when someone passes away and they leave money to beneficiaries, the property has to be administered. So it's like taking it from the decedent to the survivor. That's called the estate administration process. So usually you're going to have a successor trustee that's named in the trust. So have no idea what they're doing because they've never done it before. So then they call on GQ Law and we walk them step by step on how to be a successful and good successor trustee. We also do the required notifications. We notify the Department of Health Services and all the legal requirements so that they can have the estate administration done properly. We help successor trustees be successful.
Call or click to request your free consultation. GQlaw.com. 855-500-TRUST. GQlaw.com.
Time is running out. To join us
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. GQlaw.com.
You're live.
All right, you're listening to The Word on Wealth, and today we've got this our Tax Monday. We've got Rich Mathurin from GQ Law, and so the first part of the show, we were talking about how, in addition to the IRS coming after people for failure to file tax returns and failure to be obedient to these crazy tax laws, is the Franchise Tax Board, California Franchise Tax Board, tends to be super aggressive even compared to the IRS. And so we figured out that the state of California can make up a tax return for you by looking at your W-2s, your 1099s, your mortgage interest statements that get filed. They can look at what your occupational license is, like what license you've applied for. And if you don't file a return, they can use those numbers to make up a return for you. And now we are here with Rich Mathurin of GQ Law to come up with a solution, because there's hope. Rich guaranteed promises there's hope. So tell us, Rich, what is kind of the hope you can provide for somebody that's kind of stuck in one of those situations, like the IRS or the state of California got their bank account, levied their wages, is sending notices to their clients, and it's like, oh my gosh, it's hopeless. I think I'm going to run away. What's a good solution?
The FTB really does push for payment plans. They do generally want to be paid in full. One thing to keep in mind is they have 20 years to collect their balances versus the IRS having 10. We've talked about in the past, date of assessment,
Right.
10 years for the IRS. It's 20 years for the FTB. So they do have quite a number of years to wait on you. That's
a long time to keep your head in the sand, right?
Yeah, definitely. They
Wow.
can wait you out. They do push for pay. They like 36 months. I can get them out to like 60 months. You do have to generally show them financial information about your ability to pay. What, again, we talked about what your income is, your allowed expenses, and that net income number. And that's probably going to be your payment plan for, 36 months. If it's not full pay within 36 months, then they'll generally push it out to 60 months. One thing that's good about them, generally, they're only looking back at the last 3 years. So if you I think if you probably haven't filed like prior to 2019, you might catch a break there. If they haven't
Interesting.
filed any NPAs, the notice of proposed assessments,
Okay.
you probably can get a payment plan as long as you filed for the last 3 years with them.
That seems like, I mean, that seems like a good thing. And I know a lot of people listening, sometimes if you don't have if you don't have a tax problem, you've never had an issue where you owe money, it's kind of hard to understand this. Is like, well, wait a minute, I pay taxes. That seems unfair. When these situations come up, I mean, is it ever really kind of a normal situation, Rich, or is it always like some business thing or some family tragedy? What causes have you seen that people they just don't file for a long time? Is they just don't know, or they're just that messed up, or
It runs the gamut.
Okay.
You know, some people are anti-tax. Some people do have medical issues, lost their job, have moved and changed jobs, type of thing. I don't know, just didn't really think about. I think some of them people just get overwhelmed and don't think about it and just don't file. Not that they're don't want to pay their taxes. They just kind of get overwhelmed. I think that's a lot of the cases.
And it almost seems like sometimes you don't file 1 year and you go, oh, dang it. And then the next year rolls around and that may seem like, oh gosh, how could that go that fast? When you're in business, the world you just keep moving, right? So then it's like the next year, it's like, oh my gosh, I didn't file tax returns last year. If I file them again, and then next thing you know, it's 3 years later. Oh, I haven't filed tax returns. I'm 3 years late on that one. I'm 2 years late on yesterday. I'm 1 year late today. If I file now, they're really going to come and get me. And they just kind of like are almost like terrified. Like if they file a return and admit that they owe, then what's going to happen? It just seems like it's a scary thing. That's why I'm glad we're talking about like solutions, like what can be done with this kind of thing.
Yeah. Another thing that the FTB is good about, we've talked about the non-collectible status in the IRS, the CNC. The FTB has a program called the hardship status. That's where you provide financials and show that you don't have the current ability to pay on your taxes. And they will provide a hardship where they will not do any collection activities against you for 1 year. You have to renew it every year. It's not just a continual thing like the CNC status with the IRS. But I've had pretty good luck in getting a lot of clients that did, were able to get income and stuff like that. We're earning income, but we're still able to qualify for the hardship status. But again, you do need to show a financial statement, bank statements, all the like.
Now, it seems like, if you get into a hardship status, that the franchise tax board wants kind of this annual review, like, okay, show us what you're up to now, show us how much money you're making now. It really seems like, and kind of, I want your kind of take on this. It seems like the state of California is willing to work with people, but they really want like this full disclosure, full cooperation, none of, no kind of partial disclosure and that. What's your comment on that?
Yeah, I've had good one. Like I mentioned earlier, I think the good thing about the franchise tax board is you can call and you can get a representative and you can work with that person and speak with them. And, well, maybe they need more information on this and you give it to them and you work with them. And you can call back and get the same person, fax the same person. That's been very helpful in my experience in trying to set up, a payment plan that the client can afford or get them into hardship status. So it's good to be able to deal with, one person, which is good with the FTB. They have a couple of different departments depending on your balance and how many years you owe for, type of thing. So that's always fun to try to figure out what department you're in the FTB. One thing I should mention is they do have the offer and compromise for both personal and business.
Okay.
But I think we have found that they really, really push people into payment plans. We have not seen in many, if any, cases where they have accepted an offer and compromise. I had a case like we did an offer and compromise for a couple that one client had dementia and the wife was taking care of him. And we did submit an offer and compromise, and I figured they would be a perfect candidate. And the FTB said, no, we're not going to accept the offer and compromise, but they put them into a hardship status. So, it's sort of a different approach than the IRS. They really push you into a payment plan or the hardship status, and they want to look at your thing every year, type of thing.
Interesting. It seems more, because the offer, if you can get an offer like you do so well with the IRS, it's kind of it's done, that it's resolved and you're moving forward. You have to comply and stuff, file your taxes in the future. But with the state of California, it almost seems like, and I don't know if this is a correct perception, is that they've got 20 years to collect the money. So why would they compromise now? Because what if the guy in 3 or 4 or 5 or 8 or 9 or 10 years is doing better and now they can afford to pay it? It just seems like they want paid, they want hardship, they want to just they don't want to ever give up on somebody, which is like, give up on me.
Mhm.
But does that seem about right?
Yeah, I think it's the 20 years is driving that it's a big difference. It's double the time to collect. We talked about the notice of proposed assessments. If you
Yes.
do have those in your background, if you say they've done that for the last 5 years or whatever, I would suggest getting with your tax preparer. We have an enrolled agent that we have work with our clients a lot of times, and he fixes those notice of proposed assessments and gets the correct thing where you're getting your correct income information, getting the deductions that you deserve, and getting your correct tax assessed for each of those back years. That can save you a lot of money. I've seen it where the client might owe coming in with the notice of proposed assessments, maybe like 20 or 30,000. And our guy is able to fix those and get it down to like 5,000. That's where you save 20 grand right there.
So it's the state of California. So they've gone through this process of finding your W-2s or 1099s, or they've made up numbers. They're taking your mortgage interest, multiplying it by 6 and saying that's how much your income. They do all that. So they're coming up with these numbers, these kind of dummy fake assessments that are legitimate enough for them to take your money because of it. Are they good about accepting like the correct return?
Yes, absolutely.
Interesting.
I just talked with our enrolled agent the other day. He said that he has not, I mean, as long as, you do a correct tax return that looks proper, that he's seen that the IRS, he's only had one occasion in the past where the IRS and the FTB have asked for more documentation, but otherwise, they generally accept it if they've done a substitute for return with the IRS or a notice of proposed assessment for the FTB.
Interesting. And I think the other thing about that really fascinates me is the IRS doesn't do a lot of audits because they just don't have a lot of, person power, manpower to go back and audit returns. And you would think that going in with the IRS and the state and saying, you filed a return for me, it's a dummy return, it's a blank, it's a whatever, open assessment, here's my correct return. You would think they would be auditing those, but I don't think, have you ever seen the IRS say, okay, thanks for the return, we're going to audit it right now? Or did they usually?
No, like he said, he's never seen anything audited where he did he replaced a substitute return. He's only had him ask for more information one time. So that,
Wow.
I just had a client.
Yeah.
I think he owed 168,000 to the IRS for a substitute for return. The tax preparer redid his return, lowered the balance down to 50,000. That's $110,000 savings right there. The state, I think it went from like 20 to like 5. So, he saved like $115,000-$20,000 just by fixing those dummy returns.
I just think the message that we're getting from Rich Mathurin, he's with GQ Law. If you want to talk to Rich about your taxes, it's 855-500-TRUST. The message that we're hearing from Rich is that tax problems can be solved. It may seem overwhelming, but if you get a professional like Rich on your side to kind of work through the options that are available, there are options. And it's like, it's not worth trying to hide because the IRS has 10 years, the state has 20 years. It's like, that's a long time. Get these things resolved sooner rather than later. Fair enough?
Definitely.
All right. 855-500-TRUST. Rich, thanks for being on the air with us today. Really appreciate you. I love Tax Problem Mondays. It's kind of the time I actually get to talk to you and ask you questions on the air. So I appreciate it.
Always enjoy it.
All right. Rich Mathurin from GQ Law and Gary Quackenbush will be back tomorrow here on the Word on Wealth.
Tell a friend about the Word on Wealth, featured since 1995. With financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. The information you hear on the Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs.